Good morning and welcome to the first course offering for Market Markup. We're going to talk about segmenting the market and breaking up the market into various blocks. Give yourself little ranges, identify trending markets within those ranges, and start to differentiate the different segmentations of the market and how it likes to fill. So first thing that we're going to do is we're starting on a weekly chart. All right, we're going to start on the weekly because it's a little easier. You don't need to dive into too deep of a hole in terms of segmenting every little move. You can do it more in terms of larger scale blocks, right? So what we want to do is we'll give each one of these blocks a different color distinction. One that's easily readable, one that we can look through fairly simply. Let's try that. No, that stands out too much against the black, as does that. This is going to be the hardest part, is just finding the right color scheme. Dark teal. There we go. Okay, so if you got segment 1, if we look up towards the top, we've got segment 2. And at the bottom, we've got segment 3. So what this does is it allows us time to, here, let's do maybe like a dark red. Okay. So what this does is it allows us to really give ourselves boundaries in terms of the higher time frame before we break and fill. And this works better, obviously, the more tests you have of each one of these levels, and we can honestly break it to the point where we've got, and we will later in the course when we get into the smaller time frames, where you've got different segments for each little run up, right? And then they can carry over. But you give yourself targets, you give yourself ranges, boundaries, and you give yourself opportunity within those to find strong structure that, if it breaks, is an indicator when it's retested that whole segment is broken. And so you're able to start identifying new areas of strong volume and really strong transaction amounts, right? So might not be the drastic moves, but there'll be quick moves, right? There'll be quick moves in the smaller area, especially once you start to get down towards the smaller time frames. But first things first is we've now identified areas of market structure without having used any tools, right? So you can pretty safely assume that once we break and close, right, that's the important distinction here, is once we close with enough distance into one of those zones and then we retest, in some capacity, this is great, especially on the higher time frames if you're swing trading spot forex, because you can see that they're not exact, right? We break above, come back and close, fill to the top, come back and test, and then the momentum carries us down a little bit, fill, come back and test, momentum carries us down a little bit, almost fill, then we break in and give some distance, come back and retest, fill, break down, momentum carries us up a little bit, but we do retest, fill to the bottom, come back up. And so you can see that we're giving ourselves essentially support and resistance, but we're identifying ranges on the larger scale. And that's important, right? So identifying ranges like this and identifying various market structure is important, because what you're able to do now is you're able to go through and give yourself some various using other things that if you've taken any of the basic, like the Forex structure course, or if you know anything about, um, and you know anything about technical analysis, all I'm doing right now is drawing in some trend. And if you've taken the Forex structure course, or if you've spent any time with me, you know that when I look at trend, um, one of the things I look for is trends to be broken within ranges. And this is no different from that principle because the market likes to move in waves. The market's going to move in waves like this. And if you're not following right now, don't worry about it at all. But what it should give you is an idea for the, you know, we'll go through and we'll do a full markup just with support and resistance within these zones. And you'll be able to see just how much clearer the moves then become in terms of where they're going to fill to, where they might stop. And right now, it may, like, I want to put the disclaimer out there that nobody knows truly where anything's going to happen in the market, whether it's a dead stop or momentum carries past. But you can give yourself in certain instances, right? So we start to build some context around, you've got decent support here. You've got this little trend line that's established itself. You've got another, oh, got another right here. So this area right here looks great, especially when you consider that if you were to draw in this impulse fib, we're right at the 78.6. And you know that, but maybe if you're a conservative trader, well, you know that we've already filled this top here, right? So we've already filled up to the top of this range. Maybe you'd wait for a break and then a retest to go short, which never happens. But that doesn't matter because we broke into the upside and now we retest. And if you take your fib again, take this impulse, that break and retest, well, the initial test of the low with a little bit of pips to work with is right at the 50% retracement, but the 61.8 is where it spikes to right past that little range segregator there. So what I'm getting at is you're able to start to distinguish. You're able to start to distinguish and kind of stay out of trades depending on where you are within that range. Unless you're carrying a very strong bias, right? Unless we've hit a very strong fib retracement and you anticipate, which is something I try not to do, but you anticipate a move to fill one of those zones before, profits come off and then we start to retrace back down. For instance, if we were to look here, that's exactly what happened. So we have this nice swing run here. We get the 50%, get long here, right where we had been discussing, fill up to that negative 23.6. That's when we get the retracement that we could have looked to enter the long on. So when you're thinking about it in that capacity, you're taking the ranges into consideration, but you're anticipating range breaks. And with range breaks, you can see that on all the range breaks, there's typically strong moves in one direction or the other because you're breaking significant structure. So really what these ranges do and what these market segmentations do is they give you additional bias, some confluence, and confidence to stay out, which is important, or confidence to make more calculated guesses. And throughout the series of courses that we're going to have, you'll be able to make those calculated guesses and start to trade, especially on something like this, which is a weekly time frame. Trade spot forex just a little bit more, a little bit more easily in terms of where to move your stop losses, where to be conservative, where not to. But this is just a quick introduction towards market segmentation and range structure and blocking the market, if you will. We'll go into smaller time frames and create more building blocks so you can see how this type of stuff translates to intraday as well. But this is just a really quick, 10-minute overview of what market segmentation allows you to do and help you identify those next larger scale moves and really arm yourself for better entries and even better targets.